Good day, everybody, and welcome to UFile's Facebook Live event. I'm your coordinator, Ida Celli, and with me today is Gerry Vittoratos to answer your tax questions. Hi, Gerry. How are you?
Well, not bad, Ida. How's it going?
Pretty good, pretty good. Tax season is almost over, so deadline
We're
in
at
less
the
than a
end,
week.
yeah. Well, yeah, Tuesday, right? Tuesday coming up is the deadline till midnight. Make sure you get your stuff, you get your ducks in a row. Make sure you cross your T's and dot your I's and get everything done. Especially if you have a balance owing, right? I mean, you better, if you have a refund, the government maybe is not so much of a rush to get your return, but when it comes to balance owing, though, you better file, because you don't want to get slapped with penalties from the CRA,
Exactly. So we've been to support and asked them what was the most popular questions coming their way. So here we are. I'm going to start it off. The caregiver amount for the federal. What is it?
Yeah.
Who's eligible, and how do we claim it?
Okay, so the caregiver amount is basically it's multi-layered, right? I mean that's essentially what it is. So you got what's called the Canada Caregiver Amount, which is either a supplemental amount to existing credits or a credit onto itself, depending on the type of dependent that you have. Okay, so that's essentially how that works. Okay, so from there, it depends on, like I mentioned, it depends on the dependent. So in this case, the way we work would be if it's a spouse or if it's an eligible dependent that's less than 18. So let's say you are either single family dwelling with a child that's less than 18, or if you have a spouse in this case, what happens is the caregiver amount will add a supplemental amount to those credits. Now, the caregiver amount itself essentially means that you have a dependent, whether it's a spouse or another type of dependent, or a child or another type of dependent that is in this case infirm. Okay, meaning that there's some sort of physical ailment or mental ailment that this person has. Now, you don't necessarily need disability. You don't need to go to that level in order to get the caregiver amount on the federal side. You just need an infirmity, which means you still need a note. You still need a note in this case in order to produce, in order to get the amount. So, when it comes to spouse, or if you're a single family dwelling with a dependent less than 18, then you're simply adding about $2,500 to those existing credits. So, for example, for those two credits, the way it works is you take $15,000, which is the base amount, minus the net income of the child or of the spouse, and then whatever the net amount is becomes your credit. So what the caregiver amount will do is add about $2,500 to that base amount, which means that it's going to be now $17,500 minus whatever the net income is for your child or your spouse, and then the difference will be your credit. Now, if you have other types of dependents, for example, an elderly parent in this case, you can claim the Canada Caregiver Amount, which is its own credit in this case, and the base amount would be about $26,000 to $30,000 minus the net income, and then your credit is capped at a certain amount. And again, you need an infirmity in order to claim that particular aspect of the caregiver amount. So within the program, the way it would work is you would go, let's go ahead and share my screen here. And let's go to the entire screen and share. I'm going to show it. Haida, I'm going to hide you for 2 minutes. And from here, so now we are right here in the interview. So the way it would work is whether you are claiming the spouse, or whether you are claiming a dependent, whether it's your child or any other type of dependent, like an elderly parent, for example. Okay, within their file, you will go to the medical and disability section. So that's on the left-hand navigator. You will go to the medical and disability section. So you click on that, and once you're there, under infirmity and disability, you have a section called infirmity and disability amounts for the dependent. Okay, so you simply click on the plus sign right there, and then you enter a description for the infirmity, and then you indicate whether this individual would be whether this individual would be eligible for disability or not. Now, remember, you don't need disability. So you might have a case where you have an infirmity, but you're not claiming disability. In that case, you would say do not claim disability, but you would still get the caregiver amount in this case. And then from there, you simply confirm to the software that the infirmity that the dependent has is eligible for the Canada Caregiver Amount. And that's all you need to do at that point. The program then will claim whatever claim can be done. Okay, so that could be, that in this case, that could be a supplemental amount to the spousal or the eligible dependent amount, or the Canada Caregiver Amount onto itself, depending again on the type of dependent that you have. All right, so I will hide this one. We will bring back Ida, and here we go. So Ida, I think we're really loading up with questions here. So
okay, so you want to start taking questions, and then we'll add the other ones after?
Yeah, let me start knocking out some of these questions here, because we're getting quite a few of them.
Camo.
Okay.
She has 2 questions. Are you a Union Gas or Etheridge customer? If so, can you receive the 2,500 carbon tax rebates? If this rebate is legitimate, how can I claim it? I'm a homeowner in Etheridge.
Enbridge customer. Okay. First question is, depends on the province that you're in, Camo. The carbon tax, the carbon rebate will depend on the province that you're in. So, for example, if you're in Ontario, if you're in Saskatchewan, if you're in Alberta, and some of the maritime provinces as well, you can get, in this case, and I'm assuming Enbridge, you're probably out west, I'm assuming. Where if you're an Enbridge customer, it's probably either Alberta or Saskatchewan. So in that case, the carbon tax rebate, you collect it by simply filing your tax return. There's nothing more that you need to do. As long as you're in one of those provinces, you file your return, the government will start paying you as a quarterly benefit the carbon rebate. So let's go to the second question.
Second question, I have a daughter with severe disability, and I have my dad living with me, and I pay him for helping me taking care of her. Can I claim this amount in the child tab in new file program under specific medical expenses, not claimed elsewhere, in the drop box of the cost of attendance care? If not, how can I claim it anywhere?
Okay. Okay. So, Camo, it'll depend on how old your daughter is. To me, this sounds more like a child care claim more than a attendant care claim, because your father, in this case, would have to be deemed as a medical specialist. You understand, to be able to claim it as an attendant care, which doesn't work. Your father is not specialized. He's not specialized in that way. But what you could do, if your child, and actually in this case, since she's disabled, if she's 18 and above, you could claim it as child care. The only catch, though, is that whatever you pay your father has to declare it as income on his return, meaning it essentially would be employment income for him. So you would have to actually emit a T4 slip for him in order for you to claim it as a child care expense in this case. That's essentially how that would work. So yeah, so I don't believe you would claim it under medical expenses, because your dad would not be specialized as a medical practitioner in this case. But you could claim it. You could claim it as child care, but then your father would have to declare it as income on his return.
Okay, we'll go to Steve. Does UFile provide solution for U.S. tax filing?
Unfortunately, no. No, we don't have a consumer product. And I think our U.S. division does not have a consumer product either, unfortunately. Okay.
Just a little reminder for people who are listening, please write your comments under the live video. I've noticed some are going under the post, so I don't catch them right here. So next is Charlie. Yeah, go ahead.
Yeah, let me just say hello to my cousin, actually, who's right there. Who just said hello. Christos is right there. So Christo, hello. Hello, it's nice of you to join us.
Nima, people on visa in Canada, are they tax exempt? If so, does it say on the T4?
No, Nima, no. If they are under work visa here, it is taxable income. They would have to declare a T1 return, and they would be subject to provincial tax as well. So even though they're non-residents, they don't have any significant residential ties to Canada. They would still, in this case, they would still have to declare their income, their T4. So what you would do is, within UFile, you're choosing the province. So the province of residence that you're choosing in the identification is the province that they worked in and they reside in, but you would have to add the non-resident section, okay, within the interview setup, and then complete that section to indicate that they are non-residents, and they would have to pay tax federally and provincially as well. And you'll have to determine whether they're entitled to their full credits under the 90% rule. Okay, so fill in that section within the non-resident page in order to properly complete the return.
Next question is from Charlie. How a non-resident not to claim federal non-refundable tax credits like the basic amount, the spousal amount, and the Canadian employment. CRA said for non-resident only the CPP and the EI can be claimed.
So in this case, it actually goes back to Nima's question, Charlie. In this case, what you would do is in the non-resident section. Okay, so I'm assuming they have employment income. That's why you got the Canada employment amount. I think the Canada employment amount, you're entitled to it even as a non-resident. I could be wrong though. I'll be honest with you. I'm not sure. I'm not entirely sure on that answer, but I believe you're still entitled to it. I don't believe that's based on residency. But the basic personal amount and the spousal amount, that's different. So the basic personal amount is you have to show that they don't meet the 90% rule. Okay, meaning that you have to show in the non-resident section within the interview setup, within the interview of that person, you have to declare their foreign income, because essentially what the rule is, it's not that they're not entitled to it. What the rule is that if more than 90%, if 90% and more of the income that non-resident gains is Canadian sourced. Okay, so I think I froze for a second there, so let me repeat that. So if 90% or more of the income that they gain in the year of the worldwide income is Canadian sourced, they're actually entitled to the basic personal amount, even if they're non-residents, because they meet what we commonly call the 90% rule. So to me, so the key is if they don't meet it, you have to tell the software that they don't meet it. So the way you do it is you go into the non-resident section that you have in the interview setup, and then you indicate their foreign sourced income. Okay, now they're not going to get taxed on the foreign sourced income. The purpose of entering it is purely to determine this 90% rule that we commonly call. But if they don't have any foreign sourced income, they're entitled. They're actually allowed. That's as per the Income Tax Act. They're actually allowed to claim them.
Okay. Next is Jeanne. I don't understand your question. You're talking about FHSA and work from home. So I'm believing you're asking how we claim it.
Yeah, if you could just confirm that, Jean.
Okay.
Let's go to the next one.
Karen, how are occasional sales at craft fairs, flea markets, garage sales to be handled?
So it depends. If you're doing this on a regular basis, it's basically business income. That's essentially what it would be. If you're just doing this once in a blue moon, then you could put it as other employment income in that case. But to me, the better option is actually business, because if it sounds like you're still doing it on a pretty regular basis, even if it's occasional, it's still pretty regular basis, and you're creating things, right? You're creating crafts in this case. So at that point, it would be considered. If you're creating the crafts, it's business income. Garage sales are different. Garage sales, you're selling personal use items at a loss. So to me, but overall, it would be business income.
Okay. Next question is from Grace. Can you please show how to fill out a capital expense on new file? Are there advantages not to claim these capital expenses? Is it mandatory?
Okay, so Grace, the answer is it is mandatory, meaning that you don't choose whether it's capital or current expenditure based on the criteria of the government. You have to choose. You have to basically enter it as either current or capital expenditures based on the rules. So the government has, if you go to the business guide, which I believe is the T4002. Just give me 1 second here. Let me just confirm that. Yeah, so it's T4002. They have a table that explains whether it's a capital or a current expenditure. So go through that table to determine whether it is a capital or a current expenditure. Now, in the software, let me just show that real quick. Just give me 1 second. I'm going to hide you. So actually, wait. What happens if I do this? Just give me 1 second here. Or it's not big enough. No, it's not big enough. All right. So let's just put it here. Oops. All right, and let's go here. So when I'm in a business income, for example, so let's take, I'm going to go to my interview setup over here, and I am going to choose self-employment income and go there. So once you're in self-employment income, your capital expenditures, so let's say I got a business, your capital expenditures is the CCA section in the left-hand navigator. So you see it right there. Okay, so it's called CCA, or capital cost allowance, which is the technical term, the tax term, excuse me, for tax depreciation. Okay, that's essentially what the expense is. So once you click on that, okay, you choose the category that, or the class that is relevant to the item that you're trying to claim. Okay, so so a lot of times, for the most part, it will usually be class 8. Okay, because essentially it's either equipment or furniture or stuff like that, or if it's something related to software, or if it's related to computer equipment, you go to class 50. Okay, so that would be either one of these classes. So each one, you see the descriptions of what you enter in them. So when you click on either one of them, if the item has been purchased in the year, then at that point, you go into descriptions of the capital additions. Mind you, you could be entitled to the full expensing of those items under what's called the immediate expensing. So when you choose here description amount of AAIP, that's usually what you would enter. If you want to claim the full amount as a full expense, you simply enter it in there. The program will take 100% depreciation, because for a good chunk of these assets, you're actually allowed now, since 2022, you're allowed to expense them at 100%. Okay, even though they're capital expenditures. Okay, you're allowed to do it. So you simply plug it in there and you plug it in. If you don't want to expense it at 100%, then you limit the amount that you want to expense, okay, under the next, in the next field. All right, so that's how you would do it. All right, Ida, I'm going to bring you back. There you go.
Next question is from Kevin. Can I claim the MER for a non-registered account as an investment expense?
That's a good question. Yeah, that's a management. For those of you who don't know what the MER means, is the management expense ratio, which is basically what is charged directly on the mutual fund. I think the answer is, to me, the answer is no. And the reason why I would say no is because the price that you're getting on that mutual fund, okay, or on that ETF, depending on whatever you've invested in, it's already reflected in. It's already been taken out of the price. So by taking it again as an investment expense, you're double dipping. So to me, the answer is no, you would not. Basically, it'll be reflected on the price. Essentially, so when you're selling it afterwards in a non-registered account, it's already reflected in the sales price that you're selling it at.
Okay, next question is from Dale. Sorry, she's sent it on different messages. So she has some questions regarding the T2. If she created a company in November 2021, would she need to fill out a T2 for that year? And how to claim the foreign tax credit for her business?
Dale, it depends on the year end. So you could create a company in November, but what's your year end? It's not when you create it, it's when the year end is of that company. So it really is the year end that will determine if you're filing that return now or not. Okay, so what year end have you chosen for this corporation? Okay, that's really the answer to the question. Okay, at that point, so simply choose whatever it is, choose it, and then you basically go by the deadline of the year end, not when it's created, but when the year end is. So let's say, for example, November 2021, you chose December 31st as your year end. That means your deadline is 6 months afterwards. Okay, that's how it works for a corporate return.
And she's asking how to claim the foreign tax credit for her business.
Is this for the incorporated business, or is this for? I'm assuming the incorporated business.
I'm assuming too, because she's talking to T2.
Okay, so if you're in UFile T2, you will go to the income source section. That's where you would go. You would indicate the income in there, and then you would choose a country. At that point, you would choose a country. And then once you choose the country where the source of that income is, you enter the foreign tax that was paid. Okay, and at that point, the program will UFile T2 will compute the foreign tax credit.
Okay, next question is from Ravi. On a federal return for a deceased person, besides the final return, some tax clause number has to be shown. What is it?
Usually it would be the Income Tax Act reference. It would be the subsection of the Income Tax Act. Usually for deceased, it's Section 70. But I think you only put that in if you're doing an alternative return, either rights and things or something like that. I don't think you do that for the final return. It's just a tick mark basically on the return that indicates that it's the final return. Okay, if not, it would be shown on the top right of the return itself, and you should see a subsection 70 something. Okay, usually that's what it's going to show.
So we're going to go to Rosemary. My husband and I are both 65 and we have had to fix up many areas of our home and plan to live here as long as possible. What can be claimed for the home accessibility amount and what can't?
So very simply, Rosemary, it's whatever renovation has made the property more accessible for somebody who's got physical ailments. Okay, that's essentially what we're talking about. So let me just give you some examples off the top of my head. A wheelchair ramp leading into the door. For example, a more accessible bathroom. Let's say railings for the toilet, railings for the shower, or you bought a flat floor shower, for example. In other words, you could open it as a door and just walk out directly. Okay, so these are examples of what you can claim. Okay, so anything that makes the property accessible. Another example would be what's called a stair elevator. Right? A stair elevator for somebody who can't go up the stairs. Okay, so that's another example for home accessibility. So that you go directly on the website, on the CRA website, which is cra.gc.ca, type in home accessibility. Usually they should provide you with more examples than what I'm providing.
Okay, next question is from Raymond. What is the ACWB? Do I need to put it in my tax return?
ACWB, hold on. Just give me 1 second. Okay, the advanced Canada Workers Benefit. Yes. Okay, so that's a refundable credit. The answer, so that's the advance. So that's what you got ahead of time, which the government had announced last year. Okay, so that was a change the government had announced last year. Okay, where if you were eligible in 2022 for the Canada Workers Benefit, for those of you who don't know what the Canada Workers Benefit is, very simply put, it is a refundable credit for lower income individuals who have working income. So it's either a job or they're self-employed. Okay, and the purpose of it is to basically encourage you to continue in the job market, so that way you don't lose any other benefits, such as, for example, welfare payments. Okay, so that's essentially what the Canada Workers Benefit is, which is the CWB. Now, the ACWB is the advance payment of the credit, and what the government had announced for 2023 was if you were eligible for the credit in 2022, they would pay you half of your 2023 credit in advance. Okay, and they paid it to you in quarterly installments in July, October, and January. Okay, so that's essentially what the government has done. Now, the government is supposed to send you an RC-210, an RC-210 to indicate the advance payment that you received. And this RC-210, you have to declare it on your tax return because you have to do a reconciliation on your return. Because remember, the government has prepaid you your credit based on your 2022 info. But it could be, of course, that your info has changed in 2023, which means that you might not be eligible for the full amount that they paid you. Okay, and that's why you need that slip, and you need to declare it on the return in order to do the reconciliation between what you should have gotten and what you actually got. And if there's a difference, you will pay the difference.
Okay, next question is from Pat. It's a little bit long because he gives us a bit of backstory. So I am filing my elderly parents' 2023 tax return. Both have RIFs. My dad passed away in August 2023, and the remaining balance of his RIF was transferred over to my mom. He received a T4 RIF receipt showing the minimum amount that was paid out to him in January 2023 in box 16, as well as the total amount left in the RIF upon death on box 18. My mom received the T4 RIF receipts, the first showing the minimum amount paid out to her in 2023. The second RIF receipt she received showed the amount that was transferred from my father's RIF, box 18, and as if this amount has been paid out to her, which was not. My question is, when I plug the numbers from all three RIFs, the system is saying they owe a large amount, indicating that their income for 2023 was much higher than they actually was. I think it has something to do with the second RIF that my mom received. If my dad's amount was transferred, should it have appeared in box 16 on my mom's RIF? If this is correct, do you have any suggestion on how these amounts should be input in the U-file in order to indicate that this was a non-taxable transfer and not a cash payout?
Yes. Okay. So Pat, thank you for the detailed question. By the way, that's great because I could get you to your answer in 2 minutes, in 2 seconds, literally. So let me show it to you. So Pat, essentially, what it means is now the minimum portion that went to your mom on the first RIF, unfortunately, that will be taxable for her. Okay, that's the rule. Unfortunately. Okay. So that portion of the minimum amount has to be declared. What is non-taxable, and you're absolutely right, is the remainder amount, the other amount that is transferred directly into her RIF account. So to reflect, you have to reflect that in the software. Okay, so the way to do that, let me show you right now. And you should have gotten some sort of document from the financial institution that shows that transferred amount. Okay, the financial institution of your mom should have shown that. Okay, they should have shown that in a receipt. But let me show what to do. Okay, so within the software, let's go to pension income. Let's go to the T4 RIF. So here you go to the T4 RIF income, which you already have. And then what you're going to notice here is that you have your box 16, which is the T4 RIF upon death of the spouse. And then you have the portion that is transferred to a RIF. Okay, so you have to do a double entry here. You have to enter the amount that is shown on the slip, which is 16, and then enter the portion of 16 that has been transferred directly to your mom's RIF account. Okay, so you have to put both of them, and a lot of times it'll be the exact same amount. You'll actually just do a double entry in that case. The moment you enter that amount, now the program will deduct the transfer amount in your mom's net income and not tax the income in your mom's file, which is what is supposed to happen. And at that point, you will see a dramatic change in the amount of the balance owing. So remember, box 16 right here, you enter your amount, which is what is reflected on the slip itself, and then you enter the amount that is transferred directly in your mom's account within where it says portion of box 16 transferred to a RIF. Okay, that's what you would do, unless it's an RSP, and then you would enter it in that box. Okay, but I'm assuming it's a RIF in this case. All right, let's go back. Let's bring Ida back.
Okay, we're going to the next question. Is from Eric. Question about the autofill. When I enter my spouse's information, it autofills her 2024 RSP info. The problem is the program gives me a warning message saying 2024 is above the regular number. I understand as 2024 RSP should not be reported in this year's tax info. Can it be because of unused RSP contribution from the previous year or because of HBP, home buyer's plan?
No, I find that bizarre that you're getting 2024 RSP info. Normally it should be whatever's on the assessment from the previous year. Because your last assessment would have been your 2022 return, which would have mentioned the 2023 info, not 2024. So that's why I think you're getting the warning message. I find that very bizarre that you're getting that. That's because normally the government should not emit any 2024 info until they get your return, because there's no way they could compute what your eligible amount is, what your limit is, until they get your return and they know what the earned income is. So yeah, it's very bizarre. That's very, very bizarre that you're getting that. Eric, contact our support. You would have to contact our support line for that one. I'm not sure why you're getting that message. I don't know why the government is sending that 2024 info. That doesn't make sense to me, because they don't have the return.
Okay, next question is from Nastenka.
Okay.
Sorry if I don't pronounce it correctly. My daughter is 24 and lives with us. She has a small income in 2023 and prior years. I have included her as a dependent and she has declared her taxes as part of the family. She finished university in 2022. Can she still fill taxes as part of our family? She lives with us.
Yes. Yeah. I mean, obviously, from the looks of it, she doesn't have a lot of income, so it's not a complicated return. So yes, you could continue having her as a dependent. The only difference will be, since she doesn't have any tuition amounts to transfer, nothing gets transferred. Essentially, that's all that's going to happen. But you'll still have her as a family member there, and it'll be fully functional. You'll be able to file for her as well. Even if you're not transferring any amounts on her behalf, you can still file for her. You can still have her as a dependent and still file. No problem.
Next question is from Sunny. What are the different tax treatment between a married and a common law spouse?
Nothing.
Filing status.
To nothing. To the government, it's one and the same. Okay, so remember, common law, common law and tax law is two different things. Okay, so when it comes, so to the government, all it means that you have a spouse at the end of the year. That's all they want to know. Whether your spouse is your spouse because you're married to this person, or whether you are common law with this person, does not matter to the Income Tax Act. The rules are exactly the same on how you either transfer credits between each other and how things are claimed. So nothing changes there.
Next question is from Julie. Can I file an adjustment to claim textbooks and tuition from prior tax years, i.e. the adult professional learning plan?
No, because you can't claim textbooks. You can claim tuition. You can't claim textbooks, though. But tuition, you can. Yes, you could amend your return. Julie, the quickest way of doing it is either refiling. So, in other words, go back to the previous year, put in the tuition fee that was missed, okay, and then just refile the return under the net file tab, or just go to the My Account portal of the CRA, and you can amend your return directly on the government's website. That's another way you could do it, but not textbooks, though. You cannot claim textbooks. Those are not allowable. Only tuition is allowable.
Okay, from a next question from Denise. GST rebate on owner billed for major renovation. GST 191.
We don't have that. Let me have a look at that form. I'll be honest, I'm not as well versed on GST construction summary worksheet. Well, we don't have it, that's for sure. I'm just looking at the form now, and I don't think it's really claimable anywhere on the return. Construction summary. Okay, use this worksheet if you build a new house or essentially renovate your existing house and you are filing a GST new housing rebate application to claim new GST new housing rebate. Yeah, no, we don't do that. That's not on the personal return. You would have to do it separately.
Okay, let's go to Carolyn. If I want to correct a few items on a prior tax return, is refile using UFile the best option, or can I add to this year's return?
No, refile. Carolyn, you can't add things from previous years into the current year. That doesn't work. Okay, it has to be whatever these amounts were within the calendar year. So you just refile the previous year's return, which is really child's play. Using UFile, you just go back, make the changes in the file, go back to your net file tab, and there's going to be an option there to refile. Just click on it, and you're good to go.
Okay, moving on with Mohammed. I was ready to file tax returns and my spouse's file disappeared. I had to do all over again, even the history part. What would be the best way to handle that situation?
Well, I mean, if it deleted, there's not much you could do there. If you saved the file and it deleted, you should be able to go back to the previous version of the file. So if you're saving the file along the way, that's the best way to avoid this, is that as you're working on your file, save along the way. And if you notice that something happens to it, you could always just close UFile and go back to that file, and the file should be there. That's the only way that I could think of, as far as that.
Okay, next question is from Dave. Last year I did my own taxes with UFile, myself and my mother. My mother is now deceased. I am not able to file my return, which is connected to my mother. Can this be changed? Or her form has asked to fix errors. The last error is her bank 3-digit ID. I am not able to enter anything in that box.
Dave, you would have to create her as her own family head. Okay, so you can't do a deceased return as a dependent, at least to my knowledge. You can't leave her there as a dependent and do a deceased return. Let me check. Oh no, hold on. I stand corrected. I stand corrected. I'm in the dependents file, and no, there it is. Yeah, you could do it. There you go. Final return. It's right there. Okay, so I stand corrected. You could actually do it. So in that case, contact us. It's very hard for me to determine why you're getting that message. What's called because you should be able to file. I'm looking at UFile for Windows, and it's working. So the 3-digit bank ID that you'd have to check with a bank. Otherwise, contact our support line in that case.
Okay, next question, Libby. I'm in Ontario filing GST, HST using Quick Method for a service-based business. Do I need to use two different remittance rates if I provided services to both Ontario clients and one in Quebec?
I don't believe so. No, it's where the business is run. It's where your establishment is. So if you're in Ontario, you could have Quebec clients, but if you're in Ontario, no, you will not be using two of them. At least to my knowledge, you would not be. You would not be in that case.
Okay, Parissa,
Yep.
who is eligible for the Quebec Tax Shield?
Okay, so the Quebec Tax Shield, just to give everybody, so before I get into who is eligible, let me explain what it is. Long story short, I will try to make it as non-legalese as possible. So the Quebec Tax Shield, very simply put, what it is when your income increases from one year to the next, some credits and benefits will be lowered because they're based on your income. Okay, so that's essentially, this happens all over the place. Okay, so for example, whether it's medical expenses, whether it's childcare expenses, whether it's work premium, which are, by the way, the two things that the Quebec Tax Shield targets. Okay, so for example, as your income increases, these credits will decrease because the credits are based on your family income. So of course, if your family income goes up, your credit will go down. Okay, what the Quebec Tax Shield does is that it creates a buffer. Okay, that's essentially what it does. So for example, if you made up to $5,000 more, you won't lose out on the credit that you were claiming last year, on the credit that you claimed last year. Okay, that's what the Quebec Tax Shield does. That's why it's called the tax shield. Okay, so it gives you that buffer, essentially meaning that even though you've made more income, you're not going to lose that credit. Even though the credit is normally based on, reduced progressively based on your income. And there's buffers. There's usually about chunks of $5,000 if memory serves me. Okay, so the Quebec Tax Shield would be people who would be eligible are people who claim either the work premium or who are claiming childcare expenses and who have seen their income increase, during the year by less than, let's say, $5,000. I think that to memory it was 4. I think now they've increased it to 5. Okay, that's essentially who would be eligible for the Quebec Tax Shield. So hopefully I've explained it in non-legalese. This was actually an innovation of the person who came up with this was a professor of mine, actually, when I was doing my master's, actually, Luc Godbout. For those of you who watch RDI or the French news channel, he's always there, and he's the one who came up with it. All right.
Next question is Sam. I worked from home the entire year of 2023. I own my home and I'm not a tenant. How can I enter my office expenses for home tax credit?
Okay, I'm assuming you're an employee. I'm assuming, then in that case, you go to employment expenses. Okay, so when you go to the interview setup section, you click on it, and then on the page to the right, there's going to be a section for employment income where you have the T4. You're going to see a section called employment expenses. Tick that box, click next, then an employment expenses section will appear just below your T4. When you click on that, you're going to choose the option. You're going to choose either salaried or commission income employee, whichever one you are. Okay, actually, let me show it. Actually, I think it's better instead of visual. I think it's better to visualize it. So give me 1 second here. All right. So when I go back here to my interview setup, as you see here on the page to the right, you see a section called employment expenses. That's where you go. And again, Sam, I'm assuming you're an employee. Okay, I'm assuming if you're not an employee, then it's under business income. When you're in your business income, so for example, right here, you see I've already got a self-employment income section already preloaded. You see you have an option called home office expenses. Okay, if you're self-employed. Okay, but if you're an employee, you go to interview setup, and then you go to employment expenses. You tick that box. You click next, and then you see underneath your T4, you're going to see a section called employment expenses. Okay, you select that option, and then you choose which one you are. If you're a commission income employee, you choose commission income employee. If you're a salaried employee, then you choose salary employee. Okay, so you choose one or the other. Click on that option. Okay, and then once you're there, you're going to see on the left-hand navigator a section called home office expenses. Select that section and now complete the page accordingly, okay, based on the expenses that you have. All right, so let's bring Ida back. And here we are. Okay.
Okay, Ed, the T2125P, I inadvertently checked final year of operation and net filed. Is there a way of correcting this before receiving a notice of assessment?
Yeah, that's tricky because even an amended return, the government probably wouldn't see it. I would say just file another one next year. Just produce one again next year, or contact the CRA directly and tell them, hey, I accidentally said it was my final year and it really wasn't. Because even if you amend the return, I think the only way to really properly amend it is you would have to do a T180J, and you would have to put an explanation to the government and say, okay, I accidentally ticked. So you have to produce the form T180J. You could do it either through us. We actually have the form within UFile, or you go to the government website and you get it from there. And then you simply put an explanation in that to tell the government that you accidentally chose final year when it really wasn't, and then mail it to the CRA. But it won't. But I think honestly, even if you just file next year, just by continuing it, I don't think the CRA is going to bat an eyelash, to be honest with you. But if you want to do it officially, T180J, put an explanation. There's a box there. There's an area where you actually explain what happened. You can explain it and then submit it to them.
Okay, Homa. If the husband is not resident of Canada, does it count as a spouse?
If the husband's not resident, does it count as a spouse? Yes, you still have to declare that person as your spouse and declare their worldwide income, whatever income they gained in that other spot, in order to properly determine credits and other benefits that you might be entitled to from your return. So yes, it still counts. Absolutely.
Okay, Robert, can you, if so, how would you defer RSP contribution deductions to a future year?
Ah, perfect. Well, we have a video on that, by the way. Okay, on our YouTube page. A nice segue to plug our YouTube page. In this case, we do have an RSP contributions video. But let me show you, since you're here, let me show you how to do that. It's not hard at all. So let me show it right there. Okay, so then when you go to the RSP contribution section, okay, so you see here on my left-hand navigator, I'm where my contributions are. Okay, if you scroll towards the bottom, okay, you will see, that's your contribution limit. There's your contributions. And then right here, you have a box that says RSP, or whatever these are, deduction to use in 2023. So put in the amount that you want to claim, and the program will claim only that and carry forward the difference. Okay, so you simply at the bottom of the page, you simply go to the deduction to use entry. That's all you need to do. All right, so we're bringing back Ida. There she is.
Okay, Lindsay, how would the home office expense be split for someone self-employed on the side out of the home, and whose 9-to-5 company has just switched to remote, also from home now?
Yeah, this happens a lot. Basically, what you have to determine, Lindsay, is the amount of hours that you put in in a work week between your business and between the employment. Okay, and you will prorate based on that, on the number of hours. Okay, so if let's say that person works, so they do a 9-to-5, which means 40 hours would be business, and then it would be employment, and then let's say they work 10 hours a week as business. So then you got your proration right there. Okay, you got 50 hours total in the week. 10 divided by 50 is your percentage for business, and 40 divided by 50 is your percentage for home office as an employee.
Next question is from Jim. My son worked for Uber, a small amount, less than $1,000. Is there a simple method to calculate the expenses, i.e. amount per kilometer driven?
Well, no, I mean, you would have to. I'm assuming. I don't know if Uber actually tracks the mileage that your son was doing. But normally, first of all, it's a business. Jim, Uber is like a cab driver. It's really no different. So at that point, it is a business. What's called to calculate i.e. the amount of kilometers driven. Listen, to me, you could use apps. I mean, I'm sure Uber must have some sort of log of the mileage that your son did with them. I mean, because they have to use the app, right? As they're collecting fares, So at that point, to me, that's the best way. Or just find another app that could track kilometers using a GPS. I mean, smartphones are amazing. They have all this stuff that you could actually use to track.
Okay, next is from Susie. Can she's in Quebec. She wants to know I can claim the CCB if my spouse is a non-resident and I have the higher income.
Yes. Yeah. I mean, if you and your child are in Canada, in Quebec, even if your spouse is non-resident, the only thing you have to do is declare whatever income your non-resident spouse has gained, because the Canada Child Benefit is based on combined income, right? So the amount that they will pay out is progressively reduced is determined based on the income that you've gained. So at that point, and it doesn't matter whether you have the higher net income or the lower net income. It's not like unless you're talking about childcare. That's different. If it's childcare, then at that point, it is the lower income spouse that claims it. Unfortunately, you would have to meet the exceptional cases. Okay, so if it's childcare, the exceptional cases, I'm not sure your non-resident spouse would need it. In this case, let me check what the exceptional cases are. But if it's, first of all, Canada Child Benefit, there's no difference. Okay, it doesn't matter whatsoever. Okay, for Canada Child Benefit, but for the child care expenses, that is different. The only exceptional cases are, there's no exceptional cases for the fact that the person is a non-resident. Unfortunately, I'm not seeing anything here amongst the exceptional cases. So unfortunately, it doesn't look like it. All right.
Charlie, I believe you answered his question about those credits. Okay. Callie, my husband does consulting work. I have declared his taxes on self-employment. He now registered his consulting company. Can I still declare this as self-employed income, or do I need to do a business with the CRA?
Well, did you incorporate? Did he incorporate? Well, I'm assuming he now registered his consultant. Okay, so I'm assuming registered means incorporated. If he's incorporated, then no, it's you no longer continue to declare the income as self-employed. You declared on a T2 return under the corporate return. Now from there, what of course, I'm assuming your husband pays himself through the corporation, either as employment income or as dividend income. So that's the income that you will declare now on the personal return. However your husband pays himself from the corporation. It could be employment or it can be dividends. So that's what you would have to declare. But the income that is gained now by the corporation is now declared in the corporate return. It's no longer declared as self-employment income. It has to be a T2 return, in other words. Okay, which we offer, by the way. We do have a product, which is UFile T2, which is online.
Okay, next question is from Laura. When I enter in the amount for employees EI premium from my T4, I get a warning that the value for the field is greater than the required minimum. It is over by 1 penny. What do I do?
Well, that shouldn't prevent you from filing. You do get the warning, it's true, but I don't think it's a warning that prevents you from filing. So you should be able to file the return. Just submit it, and if not, literally just change the penny. I mean, honestly, it's not gonna have the effect. It's not gonna have any effect on the return, quite frankly. But I don't believe it's a message that prevents you from filing. So just go ahead and file. You don't have to worry about that.
Next question from Brian. What happens if a crypto exchange doesn't keep proper records? How do you calculate your capital gains?
You're responsible, Brian. It doesn't matter whether the crypto exchange does it or not. You are ultimately responsible for tracking your transactions. So my suggestion to you is, smartphones are great. They should have apps. You should be able to find an app that would be able to track some of the transactions for you. But you're ultimately responsible. It's not, even if the crypto exchange does not keep track of it, you are responsible. You have to keep track. They must have had statements that they submitted to you quarterly. Check the statements and check from there to see what how you can determine your gain.
Next question, Noma, how to claim own business?
Self-employment. It's what I showed before, right? I think I showed people where to go for self-employed business. So you go into the interview setup section of the of the left-hand navigator, and then from there go to the self-employment section, tick the box for self-employment, click next, and then on the left-hand navigator you're going to see self-employment income there. Click on that and declare your income. That's what you would do.
Next question is from Farhad. Self-employed ice skating coach claiming travel expenses. Can I claim gas, mileage, maintenance, registration, and insurance? Also, I pay for parking and then get reimbursed. Do I claim it as income, as it is included in my check, and then claim it as a business expense?
So yes, everything you just mentioned right now, the answer is yes, as long as the purpose of the travel is to get to a location where you're going to be paid for your services. So absolutely, all these things are eligible. Everything you just mentioned right now, they're eligible. The parking, though, you're reimbursed. So in that case, it's either you declare the parking and then you declare the reimbursement as income. Okay, as you add it to your business income, or you don't declare the expense at all. Okay, because you are reimbursed in this case. So it's either or is what you would have to do.
Okay, Miranda, could you show me how to complete the work from home section? I have a T2200 from my employer. Okay.
Perfect. So I showed before where to go. So let me go back here. All right. So again, interview setup. Okay, you go to interview setup, and in the employment and other benefits section, you tick the box next to employment expenses. Okay, that's where you go. So you click on employment expenses. You click next, and then what happens in this case is that you will see a new section called employment expenses that will appear in your left-hand navigator. The first option that you have to choose is whether you are a commission income employee or a salaried employee. Okay, that's the first thing you have to choose. All right, so usually most people that are listening to us are usually salaried. So you tick the plus sign next to salaried, and then a new section will appear in the left-hand navigator called home office expenses. Click on that. Okay, click on that, and then once you click on that, you enter. In this case, you're going to enter the percentage of your home that you're using for personal reasons. In other words, you have to now determine what percentage of your home office represents what percentage of the home office takes up your home. So in other words, how much does this home office represent in square footage vis-a-vis the rest of your home? Okay, and then you might have a second calculation to perform if your home office is in what the government calls a common area, meaning, for example, you're in a living room or a kitchen, okay, or in a bedroom that you're also using to sleep in. Okay, so you might have to do a second proration based on the number of hours that you work during the week. Okay, whatever percentage you determine from that, you enter the opposite in the program. For personal purposes, you enter the opposite, and then you enter all of your expenses, okay, directly in there, whatever is allowable. Okay, so that's how you would do it. All right, so let's bring back Ida. There we go.
Okay, next question, Jan. We answered the T2200 question. She also wants to know how to enter the FHSA.
FHSA. All right. So the FHSA, the way you would do it, let's go back. By the way, we have a video on that as well on our YouTube page. Again, shameless plug of our YouTube page. So just to show you guys that a lot of your questions, they're answered by resources that we provide. Okay. So you simply go to our YouTube page, our official YouTube page for UFile, and we actually show you how to enter your FHSA contributions. Let me show you right now how to do it. So from here, all right, let's go here. All right, so actually, wait. Just give me 1 second. Huh, okay, all right, so I can't switch it around. Okay, so sorry, Ida, I'm going to hide you again. Let's go back. So from here, FHSA, you'll notice a section that appears by default with all the files. You're going to see HPP, LLP, FHSA. Choose that first. Go to the FHSA information and limit section. Right there on the page to the right, click on the plus sign right there, and then choose the year that you have created the account, which in this case, of course, will be 2023 because it is the first year. So just choose that. You don't need to enter anything else on this page, okay? And then from there, you go to enter the actual contribution that you made, you go into the interview setup section. okay, of the left-hand navigator. And on the page to the right, you will notice here the pension income and other income section. Tick the box next to pension income where it says T4A, T4 FHSA. So you tick that box right there, you click next, and then from there, go to the section, the new section that appears on the left-hand menu, on the left-hand navigator, as we call it, which is T4A, T4 FHSA. You click on that, and then on the section here, you click on the plus sign next to T4 FHSA, and then enter your contribution. Okay, and that'll be box 18. All right, so let's bring back Ida. All right, let's keep going.
Faye, I have done 2 returns and both were rejected saying access code is wrong. I have checked and they are entered correctly.
Well, you don't need the access code, right? I mean, you don't really need the access code to, at worst, take out the access code and retransmit again. You should be fine. Because the access code is just to get additional info, but it's not required to file the return, you know? So it's not really required. I think we skipped one question by accident, huh?
Which one?
Deborah.
Oh, Deborah.
Yeah, Deborah.
Does severe sleep apnea qualify for disability tax credit?
It could. That only a medical practitioner would be able to sign off on that. So basically, remember that for disability tax credit, it has to be that whatever that condition is, it really inhibits your day-to-day activities, which severe sleep apnea usually would, okay? Because, you know, you can't sleep, right? So at that point, you can't function during the day. In theory, it should. The key is you need a medical practitioner to sign off on it. So give the disability certificate to your medical practitioner, which is the T2201. So T2201 is the form. Okay, go and get that form, give it to your medical practitioner, and they sign off on it. They make the case to the CRA that it is a severe disability. It is a disability in this case, and then the CRA has to accept it. Okay, and once the CRA accepts it, then you're good. So the key is just apply for it. That the worst you could get is a no. That's the worst you'll get.
And I believe we also skipped Selena. I am behind on doing my taxes. I find it easier to file 2023 and then go backwards. Is there any reason I cannot do this?
Yeah, there's a reason you shouldn't do this. You could do it. On a technical level, the government is not going to stop you. But you shouldn't do it because a lot of what's on your tax return is based on the results of the previous years. So one perfect example of this is your RSP room and limit. Okay, so your RSP room and limit is based on your previous year's returns. It's 18% of what the government calls earned income, meaning it's income that you worked for during the year. Well, in 2023, you don't have an accurate picture of what your limit is in this case. You don't have an accurate picture of what your limit is because you haven't produced your previous year's return. The government doesn't know until you file. Okay, so and of course you could also be entitled to carry forward, to deductions and credits that have been carried forward from previous years that again you won't know unless you file your previous year's returns. Okay, so my suggestion to you is to do the previous years and then do the current year so you have an accurate picture of amounts that you can use and that you can claim in the current year.
Next question is from Sarita. A student who was here in 2023 and has returned and was not here on December 31st, 2023, wants to file a tax return. Would it be a non-resident? What address would they use?
Were they considered residents while they were there? That's really the question. Or were they always non-residents? Right. That's the first question that we need to know. Okay. If I take either one, if they were residents, then you would have to file an immigrant return. So you would have to indicate to the government that the person left the country, they've cut their residential ties with Canada, and that would be with an immigrant, meaning EMIGRANT. Okay, not immigrant, but emigrant with an E. Okay, that's what you would do. If they were non-residents, then again, you would simply file a return, especially if they have employment income as well. Okay, that you would have to file a return in this case and pay provincial tax as well.
Okay, we go to Jeanette. Our daughter has turned 19 in November last year. She goes to college and doesn't work yet. I would assume we have to do a tax return for her. This would be first time. And And should she claim tuition on her return, or should parents claim as usual? Where do we claim that on the software?
Okay, so at 19, she's eligible for benefits, specifically GST. Okay, the GST credit, especially at no income. She'll get the maximum amount, but the only way she gets GST is by filing a return. So absolutely, you're going to file a return for her. Okay, that's not even a debate. You're going to file a tax return for your daughter. Okay, so in order for her to start collecting the GST credit, which is of course the quarterly benefit that is paid out by the government, and she's going to get the maximum on top of it. What's called? This would be the first time. That's okay. That means it's a paper file, unfortunately, in this case. And the tuition, it's up to you. Jeanette, it's really the choice is really your daughter's. It's either now one way or another. She has to declare her tuition income, her tuition amount on her tax return. Okay, it has to be recognized in the year that it was paid. Okay, so even though she's not going to use it, she still has to claim it and then either transfer the excess amount to you or carry it forward to a future year that she can use it when she starts making employment income. So that is really her decision and a family decision. Okay, if you need it, to reduce your tax to zero, then you could transfer it to you. If not, Jeanette, if not, your daughter can simply carry it forward to a future year. It's really a decision in this case and not an obligation.
Next question is from King Yi.
Mm-hmm.
If buying gifts or Amazon gift cards for tenants, where can I claim these on the rental expenses form?
Put it in other. There's really no specific expense for that. Is it a reimbursement for something? That's really the question. Why are you buying those gift cards for the tenants? What's the purpose of it? Is it, let's say, for example, it was something that broke, right? And then you got them, then it would be a maintenance and repair. Otherwise, put it in other and just put a description in it in that case.
Okay, next question is from Delia. Last year, I couldn't file my daughter's income tax return because it was for the first time. She was 17. The UFile software is set up for filing first-time tax return this year?
No, Delia, it's not that the UFile cannot file. It cannot transmit the return electronically. Okay, that's what it means. And that's not us. That's a CRA that imposes that limitation. When it's a first-year return, because the government does not have a file of your daughter, they cannot accept the return electronically. Okay, that's a CRA-imposed limitation, not UFile. UFile is fully capable, which means that in that case, when you fall under an exclusion of e-filing, doesn't mean you don't file. It means you print the return and you mail it. Okay, that's what it means, which UFile will produce all the required forms that you need to mail to the CRA. So now, if you haven't filed yet the first time, you would have to go back to the previous year and file. Okay, because even if you try now to submit your daughter's return this year, if they don't have a return, if they don't have the previous year's return on record, the government is going to assume again that it's the first year filing, and they won't accept it again. So you have to file the 17-year-old return, in other words, when she was 17, and then once they accept and they assess it, now you can start electronically filing the returns for the future years.
Okay, I think Faye, you did reply. If the spouse was not living in the same country, they're asking, when living apart, what benefits are there?
Depends on the province. If you're talking about involuntary separation, or are you talking about just one spouse in another country?
No, I think he's a non-resident. He's not here yet.
Okay. What benefits are there when living apart? What benefits are there? I mean, listen, there's no, you're still considered with a spouse. If your spouse doesn't have any income, you could claim your spouse for the spousal amount, as long as you show proof that you're providing subsistence to your spouse. In other words, i.e. money. So you would have to show any cash transfers you make to your spouse, to your non-resident spouse. But that's about it. I mean, the rest of it is basically, you're still going to be considered with your spouse. There's really no difference there.
Okay, we're gonna go to Kitty. Change of use from principal residence to rental for 4 years, and switch back to residence for parents 2023. What elections to file?
Well, listen, if 4 years ago you're supposed to file an election, which would be subsection 45.2. Okay, principal residence to a rental. That would have been 45-2 in order to not declare the deemed disposition. Okay, that's the purpose of 45-2. Now you're switching back. That would be 45-3. That would be a subsection 45-3 election. It would be 45 brackets 3. Okay, and that one you don't file until you actually dispose of the property. Okay, that's the only time you would actually file a 45-3. But 45-2 would have been due the year of the change of use, which would have been the year that it was first switched from principal residence to a rental. Okay, so those would be the elections in this case.
Okay, Amar, my CRA account indicates an RSP deduction limit. Can I claim the deduction for tax year 2023 even though I am over 71?
You can, in theory, as long as you have carry forward contributions that you haven't used, then you're actually allowed to continue to deduct. Okay, because even if you're over 71, you're still accumulating your RSP limit. What you can't do past 71 is make new contributions. You're no longer allowed to do that. But for example, there's a lot of people that do this trick, which is that they will massively overpay, over contribute the year they turn 71, and then carry forward to the future years. That way, they can continue to deduct on their RSPs in the future years as long as they continue working. The key is that they still have to have a limit and they still have to continue working. Okay, that's how that works. Okay, so the answer is yes, but you would have to have a carry forward of a contribution that you have never deducted in the previous years. That's the only way you could do that.
Next question, Yaroslav. Can I claim 100% ITC in one return for a vehicle I used for business more than 90%?
ITC. I'm not sure you're using the right acronym, Yaroslav, because ITC is the investment tax credit, which I don't think is what you're asking. Are you asking for depreciation, Yaroslav? Can you just answer that? Are you asking about depreciation? Because I'm not sure.
Okay, we'll move on to the next one. Parissa, is it possible to file taxes online for a family who enters Canada in September 2023?
The answer is no. It would be because it's the first time filing. So because of that, it's a first year return, which means they fall under an exclusion. So therefore, you cannot file online.
Okay, Javeria, where to pay? Okay, if you are a U.S. resident working remotely for Canadian organization and earning Canadian income, how would you do it in your file?
Sorry if you go, but can you touch on where to pay taxes if you are a U.S. resident working remotely for Canadian organization and earning Canadian income? You would have to file it. Yeah, I covered it at the beginning. You would have to. You would be a non-resident subject to what we call Part 1 tax, which would be resident tax, and that means you would have to be filing a T1 return and pay provincial tax as well. Meaning you would have to have a 428 form with it. So what you would do is, again, you would choose. So I'm assuming this person is in Canada, but they're only working. But they're non-residents working for a Canadian company. But hold on. But they're not. No, they're U.S. residents. They're not unless they're physically in Canada. Yeah, no. To me, you would file it in the U.S. return in that case. You're not physically in Canada. I'm assuming, Javier. If you're not physically in Canada, then it's just foreign income on a U.S. return. You would not be declaring it on the Canadian return unless you are physically in Canada. Then that's different. Then if you're physically in Canada, working for a U.S. firm but making Canadian income, then in that case, again, you would be producing. So you would choose the province of residence and of employment in the identification section, and then you would add the non-resident section, and complete that section afterwards. Okay, accordingly. Okay.
Ronald, you're having problems connecting to the CRA. They may have some issues online. Maybe try a little bit later. RG Young, I have T4s for CPP and OAS. I can't figure out where to enter info on your file.
Oh, okay, that's simple enough. What you would do is, let's bring it in there. All right, so what you would do in that case is, again, it's pension income. So under the interview setup section, you will go to the pension income section on the right, tick the box next to pension income, click next at the bottom of the page over here. And then when you get to you're going to see this new section appear in the left-hand navigator, which is T4A, T4 FHSA, and pension income. So on the page to the right, old age security would be, it's OAS. Yes, so old age security would be T4A OAS is where you would enter it. And then CPP, you would enter under the T4 AP. That's a section that you would choose. Okay, and just to enter whatever you see on those slips. All right, so let's bring Ida back.
Okay, we'll answer a few more questions. It is now 2:10, so, and then Gerry, you can go in and answer the ones we haven't covered.
We'll go into the chat,
so next one is 56-year-old, plan to retire at 60. Any life hacks?
Well, first of all, congratulations for retiring at 60. That's awesome. That's awesome. Any life hacks? What I would say is right now, since you're close to retirement, whatever excess savings you have right now, put them in a TFSA. Don't put them in an RSP, because yes, you're going to get the deduction, but you're going to start withdrawing from it as well. So it doesn't necessarily pay you as well. The other thing I would recommend that you do. There's a lot of videos on this on YouTube, and there's a lot of literature on the websites. Look up the concept of RSP melting. Okay, that's the term that people use for RSP melting, because in that case, again, you don't want to have too much RSP savings by the time you hit 71, and then you're required to pull out of it. Okay, so that's that's some of the other planning that I would recommend. And again, there's a lot of YouTube videos on this, and there's also a lot of literature on the websites on this. The commonly used term is RSP melting. Okay, so look that up and see whether that would be feasible. It's kind of hard to give more advice in a format like this, but these are some a couple of tips that I would give you. And congratulations again.
Okay, Lindsay, your file doesn't seem to auto clean out the CAA that's fully depreciated. So is it safe to delete them when the open balance of the undepreciated capital cost 5 to 10 years later, for example, on a laptop, or the very next year on the software?
Lindsay, the reason the program doesn't clean them out is because you might be selling them later on. And if you are, then you might have a recapture or a terminal loss to declare. You understand? So that's the reason why it doesn't do it. The only time you really clean it out completely is when you actually get rid of it. So if the asset's no longer there, then you dispose of it. You do a deemed disposition at 0 and then get rid of it. Okay, that's the way you would do it. Otherwise, you have to keep it there until the year where it actually gets disposed, where you actually liquidate the asset. Okay, and then at that point, you have to determine a calculation whether it's a recapture, meaning you sold it for more than what it's worth, or a terminal loss, which means that you sold it for less than it was worth, and at that point you would have an additional deduction that you can claim.
Okay, Nikki, I have CPP overpayment. It's greater, line 44800 is greater than 750. It is over and entered correctly, but it won't let me submit. It keeps giving me the warning. How do I get past this?
Okay, so you have an overpayment. It's giving you a warning. Yeah, it's a good question. I don't know why it's giving you a warning, because ordinarily you would be eligible for it unless it's a restriction of the government, unless the government restrictions. So I don't know why you're getting that. Nikki, contact our support staff and see what can be done, because we would have to look at your file. I don't know why you're getting that message. I'm not sure for that one.
Ping, when downloading from the federal and Quebec employment slips, do I download it only from one of them, or I have to download from both? I tried both and the income is doubled. Autofill. I would say do federal. Okay, do federal would be the prime one, because that's where it's based out of. And then for Quebec, I would say just plug in the Quebec only numbers. Like for example, either box A, box E, box J. Those would be the ones that I would enter, manually, and that's it. If you're getting doubled like that, the reason for that is unfortunately for a reason that we ignore, that we don't understand. Honestly, the Quebec government seems to change the descriptions of the slips for some reason, and because of that, the
software thinks it's a brand new slip, and it's a brand new employer for some reason. I don't know why they do that, but they do. So because of that, I would say do the federal, and then from there, just plug in the additional amounts for Quebec.
Okay, Romeo, for foreign pension income, what is the maximum exemption with existing tax treaty, like for the Philippines, I guess?
Okay.
Seen 2011, and would like to know if this means available deduction against the pension.
Okay, 2011, no. A 2011 deduction, you would not be eligible. Pension income is not one of those incomes that would be eligible. It's only dividend income and interest income, and not rental income. So it's property income, in other words, that other than rental income, which means interest, dividends. I don't even think capital gains would be eligible for it either. In this case, it's not property income. Now, as far as what is exempted, you would have to go to the treaty. Okay, you would have to go to the treaty between the Philippines. I'm thinking it's Philippines, right?
I think it is, because Phil's.
Yeah. So for the Philippines and Canada, and within the treaty, it's going to tell you whether there's a portion of that income that is exempt. So you have to look up. So just Google Canada Philippines tax treaty, and then from there, there should be a section called pension income, and within that section, it's going to explain to you what within the treaty what is exempt. Usually, there is some sort of exemptions when it comes to pension income, but you have to look at the treaty and see whether it is.
Adolfo, can I split a large dental claim done in 1 year in 2 income years?
No, it's when the expense is incurred. It's date dependent. Okay, so you have to include all of it in the year that it was incurred.
Stephen, can you please explain who is eligible for the Canada Worker Benefit and if it applies to someone on worker's permit?
I think I did a little bit earlier when it came to the advanced Canada Workers Benefit earlier in the video. I think I explained it, but just as a summary explanation, the Canada Workers Benefit, essentially it's a refundable credit, meaning that even if you're not taxable, the government's giving you the credit in cash, essentially, okay, for lower income workers, essentially. So when you are below, I think the thresholds now are what, for single individuals around 30 to 35,000, and for a family it's around 50 to 55. So as long as you're below those thresholds and you have what the government calls working income, so meaning you either worked or you have self-employment income, then the government gives you a refundable credit to help you in your to help you to stay in the job market. The purpose of the Canada Workers Benefit, if we want to go really far back, is essentially what's called a reverse income tax. Okay, that's the economic term for the Canada Workers Benefit, meaning that essentially it was designed for people who are getting into the job market and to help them stay in the job market. Because take for example somebody who's on welfare who wants to get into the job market. Well, for every dollar they make in working income, they're going to lose their welfare benefits. What the Canada Workers Benefit does is that it compensates for the benefits that they would have lost. In other words, the welfare that they would lose by going into the job market. Okay, and that's the goal of the Canada Workers Benefit when it was first introduced. And again, if you guys want to know the concept of it, look up reverse income tax. Okay, the term reverse income tax. It's going to explain essentially what the Canada Workers Benefit is. So that's essentially what it is. And as long as you're below those income thresholds, you get this refundable credit from the government, okay, and you get half of it now as a benefit now in advance. Okay, they pay you in advance for that benefit.
GS Fan, what kind of costs can I claim for work from home? Electricity, internet, gas?
Yes. So what you can claim is, utilities, which you just mentioned there, electricity and gas. You can claim your home internet, which you mentioned as well. You can claim your rent as well. Okay, if you're a renter, and if you are a commission income employee, you could, and you're a homeowner, you can claim your property insurance, and you can claim your property taxes. Okay, but but those two expenses only for commission income employees, not for salaried employees. Okay, that's what you can claim. So let's do one or two more.
Yeah, Yaroslav, I think he answered. He's asking about the HST. Can you claim 100% of ITC from HST in my tax return if I purchased a vehicle last year and used it for business purposes more than 90%?
No, you're prorated to 90%. You're prorated to your business mileage. That's what you're prorated to. So if you use the car for 50%, but in this case, you're only depreciating. Remember, you're not getting a reimbursement of your HST. No, you will actually. I'm sorry. No. I'm wrong. Yes, you can get a refund of your HST, but what's called, but you have to be a partnership though. It's not. Yeah, it's not all businesses that are allowed, actually. It's only partnerships that are allowed. So in this case, in theory, you can, but only the business portion. Only the business portion.
Okay, Ping, why can't I net file when there's a 1198, a T1198?
Because it's an exclusion of the CRA. There's nothing we can do. It's the CRA that imposes that exclusion. For those of you who don't know what the T1198 is, very simply put, when you get payments that you were owed for several years, one shot. Take, for example, you take your employer to court for employment income that they owed you for several years, and then you win a settlement, and you win your court case, or you get a settlement with your employer to be reimbursed for all that income that you were owed for those previous years. You're going to receive a T4 from that employer with a full amount that you won as employment income. Now, that income should not be taxed in 1 year because this was income that you should have collected over the years. So the T1198 allows you to tell the CRA, listen, you know, the T4 that you're seeing right now in front of you, I'm not supposed to be taxed only in the current year. I'm supposed to spread out this income over several years because I should have collected it in the previous years as well. Okay, and the T1198 basically makes the demand to the CRA to spread out that income and reassess those previous years. So because of it, because it's a special situation, the CRA does not allow for the transmission of the return if you have that form because it's an election that you're making. So at that point, unfortunately, it is a government-imposed limitation, not U-file.
Okay, Kiram, do you have any tips for a married couple filing together who are both self-employed, separate business? Are there any benefits programs we could take advantage of that are commonly missed? One of us started a business in Quebec in December and has expenses but no business income for the year by year end. The other business is based in Ontario.
I mean, look, what I would say is just make sure you claim all the expenses that are owed to you. You know what I mean? So if you're working from home, make sure you claim your home office expenses. If you bought, computers, make sure you depreciate them under the CCA classes, class 50, in this case. The key is, there's no, again, and that's what I say in all my interviews, is that everybody thinks, there must be some sort of magical deduction or magical credit, right? That I could claim to really maximize my return. But for the most part, unfortunately, where people miss out is that they miss out on things that they're allowed to claim. Okay, and they're boring in this case, but they could actually represent quite a few dollars. So what I would say is make sure you claim all the deductible expenses you're allowed. Okay, so go to the guide is a T4002, is the federal guide that explains everything that you are entitled to claim as a business expense. So make sure you do that. Make sure you depreciate the assets you're allowed to depreciate, like your car. Make sure you put in your car expenses. Make sure you claim your computers that you bought for the business. And you depreciate them, so on and so forth. So make sure that you maximize all those claims.
Okay, Pearl, what should I take note of on my EI tax? This is her first time to file as an EI. I guess she has unemployment insurance, insurance.
Yeah,
Anything?
So employment insurance, you're going to get a T4. You're going to get a T4E, and you're going to claim the income, and you're going to claim the tax that you paid. That's essentially what you do.
Okay. Dale, you have several questions on the T2. I recommend you contact our support team. They should be able to answer all your questions.
Some of those questions.
Yeah, you answered some. Okay. Go ahead, Gerry.
No. He's Dale's the guy. Actually, that's what we wrote. Actually,
yeah.
Sorry about that, Dale. Sorry about that, Dale. Yeah, sorry about that.
Okay, Lynn. We'll take Lynn we have 3. Okay, let's take Lynn. What is the T5013? Do I have to include this on my filing? Box 10 is a loss, and it's my first time receiving it.
Yes, that's your partnership income, which means you have some sort of investment where you are considered where you're considered a limited partner. Okay, so yes, the T5013 has to be declared, and it's a loss that's actually deductible. Okay, on your return. Okay, so you can actually claim it. So you simply, I'll show you real quick where to find it. So let's go here. Okay, so within the interview setup, usually you'll find partnership income within, Just give me one sec. Yeah, within investment income and expenses, you see you got T5013 under the interview setup section. You tick the box for that area. You click next. And then from there, you're going to see a new section called partnership income tax shelters. Click on that. And then you've got T5013 statement of partnership income. So click on the plus sign and then simply follow the box numbers and plug in whatever you see, whatever box numbers you see from the actual slip.
Okay, next question. Islam, I see some clients have no first name, all in the last name. You finds it error, how to solve it?
I see some clients that has no first name. All
they only have a last. Yeah, everything's a last name.
Article, you have to. There has to be a first name. They'll never pass to the CRA if they don't have it. If they don't have a first name.
Okay, Gloria, I am 72 years old. I have pensions and I have been taking money out from my RIF each year. I have to pay a lot of tax on this money. I don't have enough medical expenses such as prescription, optical, etc. to claim. Is there anything I can use to claim against this income?
I've been taking money out of my RIF. I have to pay a lot of tax on this money. I don't have enough. I think, Gloria, one thing I would make sure of is to actually do the withholdings at source, because your financial institution can actually withhold tax for you in advance. Okay, that way when you get your tax return, you don't have that shocker of that sticker shock, I guess you could say, of the income that is being taxed. Beyond that, I would say donations would be one good idea. If you have, you can't contribute to your RSP. That's too late. I would say, donations is a good one, especially when you cross over $200. Basically, you get a big credit for donations. In this case, beyond that, there's not a lot, unfortunately, that you can claim. Beyond that you can really reduce your taxes. I would say make sure that your financial institution is withholding at source the right amount during the year. That way you don't get that shock when you file your return.
Okay, we just did Lisa. As a qualified support individual for my mom, how can I claim the unused portion of her disability tax credit? If so, I have always filed her tax return separately since she does not live with me. Will I have to file her return as my dependent for you file to handle the transfer?
Yeah. Liza, like in French, we have an expression. We say asking the question is answering it. And you've basically answered your question. Yeah, you would have to add them as a dependent. There's no choice there. That's the only way that you file will allow the transfer of the excess disability tax credit between your mom and yourself.
Okay, Marcella, going back to the caregiver credit, my mom is 90 years old. She does not have a physical impairment as per Canada government page, but she cannot walk without support. It's getting hard to climb stairs, etc. And she does not have any income. And she lives with me. Can I still claim somehow the caregiver credit without any doctor's note?
Without a doctor's note, no. But to me, the way you're describing it, Marcella, that sounds like an infirmity to me. That sounds like remember, it doesn't take a disability. You don't have to get to the point of disability. Just a physical ailment is enough usually to get your caregiver credit. Okay, so I would say is go to her doctor and see if you could just get a note. Because to me, if she can't climb up the stairs, and she cannot walk without support, that to me is an infirmity. That already sounds like an infirmity to me. But without a doctor's note, there's no way you can. No, unfortunately, you cannot.
Okay. It is almost 2:30, Gerry.
Yeah, so let's cut it off because we'll answer directly in the chat. Whatever questions are there, we'll go ahead and answer. We'll come back and answer in the chat. That's what we're gonna do. That's what we're gonna do because we're already like an hour. We're already half an hour above. We got
above our time.
Yeah.
Okay. So thank you very much, everybody, for listening. Don't forget. The video will be on our Facebook page. We will also post it on YouTube. And don't forget the tax deadline is April 30th. Gerry, any last words before we sign off?
Yeah, so just to mention again, some of the questions that I answered there are found on our YouTube page. We've got some how-to videos on UFile that show you how to perform some of these entries and some of these calculations within UFile. So please go ahead and consult our official page, subscribe to it as well. We also produce a podcast where we talk about various different tax topics that to help you to maximize your tax returns. So go ahead and consult that as well. Our Facebook, like our Facebook page so you can get notification for our next Facebook Live. And we also have our website at ufile.ca where we have a nice blog where we write a lot of articles on various topics of the tax return where you can maximize your return. And we offer all this for free, just like this Facebook Live. We don't ask for anything. We offer it for free as a thank you for being clients with us. So don't hesitate to use all those resources to help you in maximizing your tax return and helping you finalize and produce your tax returns using our software, using UFile.
All right. Okay. So thank you, everybody, and good luck for the end of tax season.
Take care, everybody.